All right, today we're going way off the beaten path. We're venturing into a corner of the stock market that honestly, most people, and definitely most of the big money, completely ignore. It's a place where some absolutely incredible opportunities might just be hiding in plain sight.
I mean, just let that sink in for a second. While all the major indexes are hitting these crazy record highs, there is an entire chunk of the market priced as if we are still in the middle of a massive financial crisis. So the big question is, what is this forgotten corner? And maybe more importantly, why is nobody talking about it? So here's our game plan for today. First, we're going to look at why the main market is so crowded and expensive. Then, we'll go hunting in what's called the liquidity desert, a place where the big investors literally can't go. We'll get into the nitty-gritty, decoding the specific metrics you need to find value. Then we'll confront the big scary monster in the room, the dreaded value trap. And finally, we'll talk about the key to unlocking these hidden gems and the unique edge that you have as an individual investor.
Okay, first up, let's set the scene. To really understand where the opportunity is, you first have to understand where everybody else is. And right now, pretty much everyone is staring up at the exact same handful of giants.
It is no secret, right? The S&P 500, which is supposed to be this broad benchmark for the entire US market, has become incredibly top-heavy. You have this small group of massive tech companies, you've probably heard them called the Magnificent Seven, and they've grown so enormous that their performance basically dictates where the whole index goes. This concentration has just stretched valuations to levels we really haven't seen in a very, very long time.
And this chart, wow, this is where it gets really interesting. It just shows the insane difference so clearly. Look at this. On the left, you've got a mega-cap tech stock trading at a price-to-earnings ratio, or PE, of 33. The S&P 500 average itself is way up there at almost 23. But then, look all the way to the right. A whole basket of small, profitable value companies is trading at a PE of less than 15. That isn't just a gap, my friends. That's a canyon.
So, if these giants are casting such a long shadow over everything, where on earth do we find a real opportunity? Well, we have to go where they can't. We're going hunting in the desert, the part of the market that all that big money is literally forced to ignore.
Now, to really get this, we just need a quick definition of market capitalization, or market cap. It's just the total value of a company. So large caps are the established giants worth over $10 billion. But small caps, worth less than $2 billion, well, some investors call them the puppies of the stock market. And I love that, because they have the potential to grow maybe 10 or even 20 times bigger and still be considered pretty small.
And this brings us right to the heart of the matter. If these smaller companies have so much room to run and they're so much cheaper, why are they being ignored? How is a massive valuation gap like this even possible in the first place?
And the answer, believe it or not, is actually structural. It's built into the system. Just imagine you're managing a $10 billion fund. You simply can't put a meaningful amount of money into a tiny $10 million company. I mean, even if you bought the entire company, it would be a rounding error in your portfolio. These big funds, they need huge liquidity. Tons and tons of shares being traded every day so they can get in and out without moving the price. Small companies just don't have that. And this creates what's called the liquidity desert, a place where the big institutions just can't survive, leaving it wide open for the rest of us.
Okay, so we know where to look. Now, for the fun part, how do we actually find these hidden gems? This isn't just about guesswork. We need a treasure map, and that map is built from a few really important value metrics.
We're going to focus on three key ones. First, you've got the classic PE ratio, just a quick and dirty check for cheapness. Second is a metric called EV to EBITDA. Now, it sounds complicated, I know, but just think of it as a more honest, more robust version of PE because it includes debt, and it's much harder to fudge with accounting tricks. If you see a ratio below 10, that's a great sign. And finally, and this might be the most important one, free cash flow yield. This tells you how much cold, hard cash the business is actually generating relative to its price. Anything over 10%, that's fantastic.
And this slide basically gives us a simple, really powerful checklist. This is your cheat sheet. We're looking for a PE below 15. Then there's a special formula that a young Warren Buffett used to use. PE times price to book, and that should be under 22.5. It just helps make sure we're getting solid assets. Then our EV/EBITDA under 10, free cash flow yield over 10%, and finally we want low debt. A debt-to-equity ratio below 0.5 tells us the company isn't swimming in debt, it's financially sound.
Okay, this all sounds pretty great, right? So you just run a screen for these numbers, buy the stocks, and get rich? Well, not so fast. We have to talk about the single biggest risk in this entire strategy, The value trap.
This is the question you have to be asking yourself over and over again. If a company is really this great of a bargain, why is the market basically offering it to you on a silver platter? Understanding the answer to this is the key to avoiding a whole lot of pain.
So a value trap is a stock that looks cheap on paper, but it just stays cheap or gets even cheaper for years and years. The reason is usually a lack of a catalyst, something to make people notice. Because these are illiquid stocks in our desert, your capital can literally get trapped with no buyers to sell to. On top of that, they often have zero analyst coverage. Nobody on Wall Street is writing reports about them. As the investing legend Peter Lynch famously said, when even the analysts are bored, it's time to start buying. That neglect is why they're cheap, but it's also why they can stay cheap.
So if a cheap price by itself isn't enough, what is? Well, we need a key. We need an event, something that forces the market to wake up, pay attention, and reevaluate the company. We need a catalyst to unlock all that value that's been trapped inside.
And there are really 4 big catalysts to look for. First, a share buyback. That's when the company itself realizes its stock is cheap and uses its own cash to buy back shares. Second, an acquisition. A larger competitor sees the bargain and just buys the whole company, usually paying a nice premium. Third, a big dividend hike, which suddenly gets the company on the radar of all the income investors out there. And fourth, a management change, which signals to the market that a real turnaround could finally be happening. And these catalysts can have an immediate, dramatic impact. They're not just theories. Look at this real-world example from back in August 2013. Starbucks fired its CEO, and the market took that news of a new leader as a massive positive catalyst. The stock literally gapped up overnight. The right catalyst is the key that unlocks the value, and sometimes it unlocks it instantly.
So this brings us to what I think is the most important point of all, your edge. This isn't just some strategy for anyone. It's a strategy where individual investors are uniquely, and I mean uniquely, positioned to win.
Just look at the difference here. The professional fund manager has to chase what's popular and can only invest in highly liquid stocks. They're judged every quarter, so they can't afford to be patient. There's an old saying on Wall Street, you'll never lose your job losing your client's money in an IBM. It means it's just safer to fail conventionally than to succeed unconventionally. But you have none of those constraints. You can afford to be unpopular. You can patiently put your money in these illiquid desert stocks. You can wait years for a catalyst to play out, acting like a true business owner, not a quarterly performer.
The legendary investor Howard Marks just hit the nail on the head here. Superior returns, the kind that really change things, they don't come from following the herd. They come from having a different view of value than everybody else, and of course, being right about it. This whole strategy is about finding those non-consensus ideas, doing the homework to prove the value is real, and then having the patience to wait for the rest of the market to finally agree with you.
So I'll leave you with this one final thought. This is the whole opportunity boiled down. The market is offering to sell you a real, profitable, cash-flowing business for a price that a private owner would think is an absolute steal. The only catch, the only price of admission, is patience. In a world that is obsessed with speed, your willingness to simply wait might just be the ultimate contrarian edge. The question is, do you take that deal?